Welcome back to the Daily Crypto Roundup, and today is a big one because we have 4 stories that all point to the same thing. Crypto is moving deeper into the mainstream, but the risks are not disappearing. Bitcoin whales are building long positions while funding rates stay deeply negative. Litecoin has just gone through a 13-block reorg after a denial-of-service attack, raising serious questions about how quickly protocol risks can hit even long-established networks. Bybit's CEO is warning that Europe's MiCA rules may not be enough for crypto firms to actually make money in Europe. And Donald Trump has defended crypto legislation at a private event featuring names like Mike Tyson and Tether CEO Paolo Arduino, showing once again that crypto is now fully inside the political machine. So today is not just about whether Bitcoin goes up or down tomorrow. It is about who is positioning for the next move, whether older blockchains are as secure as people assume, whether Europe's regulation is helping or strangling crypto companies, and whether US politics is becoming one of the biggest forces driving the next phase of this market. Just before we continue, this episode is brought to you by Kraken, our official exchange partner. If you want a straightforward way to buy, sell, and explore crypto, Kraken is well worth a look. It's not financial advice, but if you want to check out the platform, use our link in the description. Not investment advice. Crypto trading involves risk of loss and is offered to US customers through Payword Interactive. View legal disclosures at kraken.com. And remember, we are still running the 20XRP giveaway for signing up through our link, so check the description, use the Kraken link, and follow the instructions to get involved. Let's start with Bitcoin, because this is the story that traders will be watching very closely. According to the latest market positioning data, large Bitcoin traders on Hyperliquid have shifted from being net short to building some of their most aggressive net long exposure since early March. That matters because it is happening while funding rates remain deeply negative. In simple terms, when funding is negative, short traders are effectively paying to keep betting against the market. That usually tells you that the crowd is leaning bearish. But when whales start positioning long while the broader market is still heavily short, that is when things can get dangerous for anyone betting against Bitcoin. This is the classic setup that can lead to a squeeze. It does not guarantee one, and it does not mean Bitcoin has to explode higher immediately, but it does mean the market structure is getting interesting. If too many traders are short and the price starts moving upward, those shorts can be forced to close. When short sellers close, they have to buy back in, and that buying pressure can push the price up even faster. That is why negative funding combined with whale long positioning is worth paying attention to. It tells us that the market may still feel bearish on the surface, but some of the biggest players are starting to lean the other way. And this is where the psychology of crypto becomes important. Retail traders often react to what has just happened. Whales tend to position for what they think happens next. If Bitcoin has been stuck, choppy, frustrating, or bearish looking, the obvious move for smaller traders is often to fade it, short it, or sit out. But if large players are building longs into that weakness, they may be betting that the market is too crowded on the bearish side. That is not financial advice, but from a market structure point of view, it is exactly the kind of setup that can catch people off guard. But while Bitcoin is giving traders a possible bullish signal, Litecoin has just reminded everyone that crypto risk is not only about price. Litecoin suffered a 13-block reorg after what was described as a denial-of-service attack. A blockchain reorg means the network effectively reorganizes part of its chain history, replacing one version of recent blocks with another. That can happen in proof-of-work systems, but a 13-block reorg on a major long-running network like Litecoin is not something the market should just ignore. The Litecoin Foundation reportedly described the issue as a zero-day, meaning a vulnerability that was not previously known before being exploited. But the controversy comes from the fact that GitHub commit history may suggest otherwise, with questions being raised about whether parts of the issue were visible before the attack. That is where this story becomes more than just a technical bug. If a vulnerability is truly a zero-day, the response is one thing. But if commit history suggests there were signs beforehand, then the market starts asking a different question. Was this handled quickly enough? transparently enough, and seriously enough? Now, to be clear, Litecoin is not some random new altcoin with no track record. It is one of the oldest crypto networks in existence. That is exactly why this story matters. If something like this can happen to Litecoin, then investors should remember that no network gets a free pass forever just because it has been around for years. Longevity matters, but it does not eliminate risk. Protocol design, developer response, code history, miner behavior, and network incentives all still matter. This is also a reminder that security headlines can hit sentiment even when the broader market is trying to recover. Traders can be bullish on Bitcoin and still nervous about altcoins. They can believe in crypto long-term and still demand better transparency from foundations, developers, and infrastructure teams. That is the grown-up version of this market. It is not just everything pumps or everything dies. It is about separating strong setups from weak structures and separating market momentum from protocol risk. Now let's move to Europe, because this story could become extremely important for exchanges and crypto companies operating across the region. Bybit's CEO has warned that a MiCA license alone may not be enough for firms to turn a profit in Europe. MiCA was supposed to be the big regulatory breakthrough for crypto in the European Union. The idea was to create one clear framework, allowing firms to operate across the bloc instead of fighting through completely different rules in every country. On paper, that sounds good. Clearer rules should mean more confidence, more institutional adoption, and more serious companies entering the market. But Bybit's argument is that MiCA does not solve everything. According to the report, firms may still need other licenses, including MiFID and EMI authorizations, if they want to offer products like derivatives or electronic money services. And that is where the business model starts to get complicated. A crypto exchange might get regulatory approval under MiCA, but still not have the full set of permissions needed to offer the products that actually generate strong revenue. That is a major point. Regulation is not automatically bullish if it creates a framework that sounds good, but leaves businesses unable to operate profitably. If exchanges can only offer limited spot services, but not the higher margin products that serious traders use, then Europe may end up with a regulated market that looks clean from the outside, but is difficult to scale commercially. That could push firms to focus more energy on other regions where the product suite is broader, the licensing route is clearer, or the economics are more attractive. And this is where Europe has a real challenge. It wants to be seen as a serious, safe, regulated crypto market. But if the rules are too fragmented, too slow, or too restrictive, then the biggest platforms may comply on paper while putting their real growth elsewhere. That would be a strange outcome. Europe wins the regulatory headline, but loses the commercial race. For crypto users, this matters because regulation affects access. It affects which products are available, which exchanges compete in your region, how much liquidity exists, and how innovative the market can be. Finally, we need to talk about the US, because crypto politics is becoming impossible to separate from crypto markets. Donald Trump has defended crypto legislation at a private event at Mar-a-Lago, with names including Mike Tyson and Tether CEO Paolo Ardoino reportedly involved in the wider event setting. Whatever your politics, the important market point is this. Crypto is no longer sitting outside the system asking to be noticed. It is now inside campaign rooms, donor circles, legislative debates, and banking policy conversations. Trump reportedly said crypto is mainstream and argued that banks should back off. That message will land strongly with parts of the crypto community, especially those who believe the banking system has been hostile to digital assets. It also fits with the wider US debate around whether crypto companies should have fair access to banking, whether stablecoin legislation should be pushed forward, and whether America risks losing crypto innovation to other jurisdictions if it moves too slowly. But there is another side to this as well. The more crypto becomes politically powerful, the more scrutiny it attracts. Private events, meme coins, major donors, stablecoin executives, celebrities, and political messaging all create a very complicated public image. Supporters will say this is proof crypto has arrived. Critics will say it shows the industry is getting too close to political influence and money. Either way, It tells us one thing clearly. Crypto policy in America is now a major battleground. And when you put all four stories together, the picture becomes clear. Bitcoin whales are positioning for a possible move higher while the crowd remains cautious. Litecoin is showing that technical risk still exists even in older networks. Bybit is warning that regulation in Europe may not be enough unless companies can actually operate profitable businesses. And Trump's crypto comments show that US politics could become one of the biggest drivers of crypto legislation, banking access, and market sentiment. So the market today is sending mixed signals, but they are not random signals. The bullish side is that whales are leaning long, crypto is gaining political attention, and regulatory clarity is moving forward in major regions. The risk side is that network security remains a real issue. Regulation may be more complicated than investors assume, and political involvement can bring both momentum and controversy. The takeaway is simple. Do not just watch the Bitcoin price. Watch positioning, watch funding, watch protocol security, watch regulation, watch political pressure. Because the next major crypto move probably will not come from one chart pattern alone. It will come from the collision of liquidity, leverage, policy, trust, and narrative. That is the state of crypto today. Bitcoin whales are quietly loading up. Litecoin is dealing with a serious reorg controversy. Europe's crypto rulebook may not be enough on its own, and Trump is putting crypto right back into the center of US politics. As always, stay sharp, manage your risk, drop your thoughts in the comments, smash like, follow, and we will see you at the top.